Buying businesses used to mean being the operator, but today LPs can access the same deals without running anything themselves. If you've ever wondered how to invest in small businesses passively, this conversation will be your roadmap to the strategy, structure, and upside behind one of the most overlooked corners of private investing. Welcome to the Passive Income Playbook on the Best Ever CRE Show. I am Pascal Wagner, founder of Grow Your Cashflow and a full-time LP with over 3.3 million deployed across 23 different passive deals. And I help investors build a custom investment thesis, filter through deal flow, and deploy capital with confidence. And today I am joined by Sean Smith, managing partner at Search Fund Ventures, where he's focused on acquiring and scaling cash flowing, recession-resistant small businesses. Sean built a co-investor network of over 3,800 LPs and recently just closed a $5 million fund called Search Fund Ventures Fund 1, which invests in companies like HVAC service providers and B2B logistics firms. In this episode, we'll break down what the search fund model is, why it's growing fast, why now is a good time, how Sean is vetting operators and deals for his fund to invest into, and then what you as an LP need to know before allocating capital to a fund like this. What are the questions you should be asking? What things should you be thinking about? And so all of this is oriented to help you become a sharper, more confident LP investor. And with that, let's dive in. Welcome, Sean.
Thanks so much, Pascal. It's great to be here and appreciate you inviting me on.
Yeah, man, I'm excited to have you on. So look, I think most LPs don't understand what the search fund model is. So can you help us start out by just understanding what is the search fund model? How does it work? How does it compare to, real estate, buying an apartment building? And let's start there.
Certainly. Yeah. So it's worth kind of talking a little about the history of this search fund asset class, right? And I'll use that to kind of dovetail into some of the, varying formats that we see today. And then I'll end it with where we focus, right? So to kind of start with the beginning of search or search funds in the mid 80s, and really before that, in the Ivy League MBA circles, it became more of a intriguing and exciting career path to raise capital, call it $200,000 to $400,000, to pay yourself a salary. Typically, you were raising at that time from professors, maybe some kind of people that were, in those academic circles. And you paid yourself a salary to go find a small business to buy. You'd use some of those costs, for diligence and legal fees and all that stuff. But really the goal was to, after 2 years, to find a business and then go back to those same folks, raise more capital to buy it. You'd layer in some debt, kind of like how you typically buy a property, right? With a mix of debt and equity. And then the person, the searcher who found the business, would become the CEO of that business. Right. So they would search. They had some folks that invested in them. They'd find a business. Those same folks would invest in the business, and then they would close an acquisition of that business and become the CEO. That's what's called the traditional search fund model. What's emerged in, call it, the past 20, probably more like, and really in the past like 5 to 10 years, is this concept of the self-funded search, where people don't raise any capital during the search process. They go out, they find a business to buy. And then when they negotiate a transaction with the seller of the business, they either raise capital from investors like us, or they can fund that themselves with the SBA loan, and maybe they have enough, personal capital to fund the down payment. Again, just like you buy a property, right? Mix of debt, mix of equity. So in the world of buying businesses, we call that a leverage buyout. There's more kind of variations of that have emerged. There's variations where folks will find the business, they will buy it, but they won't become the CEO. They'll place an operator at the helm. That's often called the independent sponsor model. And there's a litany of kind of implications that come with those three different models as well: the traditional search, the self-funded search, and the independent sponsor model. So I think, taking a step back, what has kind of driven the growth in this space? And just to touch on a few data points, Stanford puts out a great study on traditional search funds, because it all, they're kind of the pioneers of the traditional search fund model, Harvard and Stanford, right? In their study, if you look at how many search funds have been raised in the past year or two versus how many have been raised historically, there's been a massive spike. I don't remember the exact numbers, but it's almost double what was raised last year, and last year was double the year before, something like that. So it's really growing exponentially. And from talking to the lenders in the space, the SBA lenders, folks that are very entrenched in the deal flow, the number of self-funded searchers that have started to enter the space has seen the same kind of exponential growth rate, if not even more dramatic, right? So there's just so many more buyers flooding into the space, which might lead you to say, okay, well, if there's so many buyers, are there enough businesses out there to buy? And I think one kind of inescapable data point that is all over social media, it's in the New York Times and the Wall Street Journal, is the fact that retiring baby boomer business owners have somewhere between $7 to $10 trillion in assets, depending on who you ask and what source you look at, right? So despite the fact that there's this growth in this search fund model of buying businesses and investing, there's still so much supply of small businesses that need a successor. Right. So search funds, whatever form they're in, are solving a huge problem, which is the problem of succession in the United States. So that's a high level. Hopefully that's helpful.
Yeah, very helpful. And so this is, can you talk to us about maybe the wave, or why now is maybe a big moment for small business investors? I mean, I think if you're in the space, or you might have heard about business buying from Cody Sanchez or Roland Frazier, or there are a bunch of different people online talking about it now. Why is now such a big moment?
Yeah, I think there's a few reasons. One, the consistent kind of silver tsunami concept, which has been true for a number of years and is going to continue to be true, creates a lot of supply of businesses. It creates this succession challenge. So that's one, I would say, definitive trend. The other has been the accessibility to capital, and this one's pretty unique to the US. You have this kind of generational transfer of wealth in other places, but in the US, this SBA loan program has enabled a lot of folks to access relatively affordable debt to acquire these smaller businesses. So that's another thing that's been driving, I'd say, especially the growth in this self-funded search asset class. The last one would be probably more from the investor lens. People are seeing these impressive return figures in the Stanford studies. There's other studies that are published on kind of similar forums, like the independent sponsor model. And they're seeing these kind of, call it 30%. Stanford's most recent study publishes a 35% return profile for investors. I think that's really enticing to a lot of folks who are looking for alternative strategies to compound capital. So those three dynamics, I would say: the supply of businesses to buy, the accessibility of financing, and really a drive for this alternative form of entrepreneurship, and then the attractive return profiles for investors have kind of all coalesced to create this growth in the asset class.
Okay, and give us an idea of the landscape of business buying, right? So we've talked about, go into that.
Yeah, so I mean, there's kind of are you asking about kind of the landscape of search funds, or also thinking about private equity? And
yeah, I think it's more about like, okay, you are focused on buying recession-resistant businesses. I'm sure
That's
there
right.
are many that focus on buying software. What is maybe the landscape of all the different types of businesses that you think about when you're creating a thesis? And then, like, what are some of the pros and cons of maybe recession-resistant versus software, or depending on what's out there?
Yeah, this is a great topic. So, just to start with a few data points, again, I'll keep referencing the Stanford study. There's great data on there on where traditional searchers are acquiring. We also publish our own report on more of the self-funded search, independent sponsor world, the really kind of lower end of this independent sponsor market. The consistencies are in some of the more high-level sectors that people, or business models that people focus on. So both in Stanford study and in the data we publish, call it 60% or so of the deals, 60 to 70% are services. So that could be business services, consumer services. One of the reasons that's such a popular sector for searchers is because you may have thought to yourself when you kind of heard the overview of search funds, can newly minted MBAs really just go buy a business and run it? Is that feasible? People with, relatively less experience than most of the CEOs you think of. How are they going about doing that? And what's kind of how are they getting these 35% returns, right? The fact of the matter is, in most cases, they're targeting businesses that have lower complexity to run. And a lot of times those are services businesses. Think janitorial services, residential home services has been a really popular play. So that's kind of the first dynamic, right? The services, the stuff that's a little bit easier to run. Doesn't have a lot of CapEx, not a lot of capital expenditures, not a lot of inventory, things like that. There's, the remaining 30% or so is split among, or remaining 40% or so is split among software, manufacturing. There's some retail in there. I believe distribution was kind of carved out as its own sliver of the pie. But there's considerations for each of those items that don't exist in services that make them incrementally more complex. And there's studies beyond this kind of core flagship study. There's research and data around what drives success in these search fund models and what has caused a more, I would say, or a less favorable outcome, or even, failure, right? Loss of capital. And the more complex the business gets has certainly been correlated with kind of less favorable outcomes, right? So you see in manufacturing, putting someone who has no kind of capital budgeting experience or limited inventory management, things like that, limited supply chain experience, all these things are critical to most manufacturing operations and much less critical in a services standpoint. So, those are some of the trends you see in the landscape and why so many of the deals are services. For the SaaS deals, a similar consideration. For software deals, you've got this kind of, in any business, you've got the concept of the competitive set, right? If you do a services business, which is typically kind of localized, you need to have boots on the ground for a residential HVAC company. Your competitive set is limited to that local geography. So inherently, you're not, these large national players can't compete as effectively. If it's a software company, you're competing with the likes of, depending on where you are, Google, Amazon, or, any of the big software giants, right? One way to think about that is the concentration or the fragmentation of an industry, meaning how much of the market share is kind of owned by one or two of the big players. Industries with these national kind of economies of scale dynamics are going to have much more concentration. And again, back to kind of the landscape, that's why you see more of these deals in services, because they're fortified from that. So those are just a few examples of where deals are getting done. They're certainly getting done in manufacturing. We'll do manufacturing deals if the buyer has great experience and a track record in manufacturing, right? But you want to pay a lot closer attention to, some of the complexities that are in those businesses versus, in a services business, for example.
So when you put together the thesis for the fund, how did you go about that process? Something I'm really trying to hit home for the retail intro LP investor is that you have to have some sort of strategy or a thesis. So can you kind of walk us through maybe the decision tree of what you thought through and then what you finally landed on for your thesis?
Yeah, absolutely. So when we started, my business partner and I started kind of investing in this space about 2 years ago at this point. We came in, at least I kind of started by saying, look, a lot of these deals are using a substantial amount of debt to fund the acquisition, which means we do not want to see earnings moving around too much. We want to see predictable earnings so we can satisfy the debt requirements, pay down the debt, and bake in sort of a base level of return simply by paying down the debt, right? Then from there we can grow, and it's all upside in a sense. But we want to see these earnings that are predictable and can pay down the debt. So how do you back into a more predictable earnings profile? There's kind of top level criteria, of the if there's commodity exposure, cyclicality, recessionary sensitivity, how much of what kind of drives the purchase decision. Is it more discretionary or is it necessity based? There's a bunch of these kind of qualitative almost factors that drive that. And so where we landed was to say, how do we eliminate as much of that volatility as possible and build a thesis around predictability? And we can look at financials and we can look at the quantitative data to see that. But from kind of a, call it a thesis statement level, the thesis emerged as we back essential businesses that serve attractive end markets, right? And what that means is the business itself is mission critical to its customers. The customers need to buy that product or service. They're not going to stop buying it. If they stop buying it from our company, they're going to go to a competitor. So they're always going to have that need. And what attractive end markets means is the buyers themselves, this is especially relevant for business to business customers, The buyers themselves are in industries that are generally non-cyclical. They're generally non-discretionary themselves and less sensitive to recessionary trends or interest rate hikes, things like that. So we want to see that the business we invest in has low volatility in its earnings, but we also want to see that its customers have low volatility in their earnings so we can have that visibility, right? Examples that, what kind of gets ruled out from that. We've seen businesses that we would consider essential, like take a compliance or like a pipeline testing business, right? Focused on oil exploration and production or something similar. So it now becomes somewhat hinged to the oil and gas industry. And not only are there kind of a relatively small set of customers in that industry for a pipeline kind of services business like this, there's also some potential credit risk if oil prices move up and down, or at least there's like delays to kind of the service itself. So that rules out. It's a good example of kind of an essential business that gets disqualified because the end market moves around. Another example would be an HVAC contractor, which we would consider essential, but that services high-end restaurants. Again, a high-end restaurant is typically very discretionary, right? So in a time when discretionary spending is low, like a recession, that HVAC contractor is probably not going to have as much work, even though it's essential to its customers themselves. So that's kind of how we got to the thesis, a few examples, and it really is all about making sure that earnings stay stable so that we can pay down that debt and bake in our returns.
First off, love the thesis, and the examples were very helpful. So when you put together a thesis like this, it sounds very succinct. You can tell you're sophisticated. You can tell you've given this quite a bit of thought, right? Which is where I think you want to be as an investor, regardless. If you're listening to the show, like the goal should be to get this sophisticated about your investment strategy. That's the only way I believe that you're really going to be successful. And, like once you're able to earn money, that's like your ability to invest well is what determines your future.
You got to have a common thread throughout, right? You got to decide where you want to play and where you don't want to play, and then focus with discipline where you want to be, right?
So you talked about, so you have this thesis, but I imagine you didn't just wake up one morning and say, this is exactly what I'm doing. There was some trial and error involved. I imagine as you had some initial thesis, and as you started looking at deals, you started saying to yourself, oh, we don't like this business. Why don't we like this business? Oh, we think it's X. Let's add X to our investment thesis, and that's how we will continue filtering deals. Is that how that process went down for you? And can you go into the detail there, because I think it's important in the understanding of how to create your own thesis.
Yeah, I would draw a bit of a distinction there between our kind of overarching thesis, the essential businesses, attractive end markets thesis. That I would say we developed relatively early on. We kind of, for all the things I just said, we decided we liked that approach, and we've been fairly consistent there. But we absolutely have refined and added to our kind of, call it, second layer of filtering. Right?
Your buy box.
Which is basically a checklist that we've developed over time. We've got about 215 items in the checklist, and it grows. It grows not only from deals we look at, it grows from portfolio companies we're in, especially for portfolio companies where we sit on the board and we kind of can go into the weeds with folks to some degree. So yeah, we've developed that. We continue to develop it and learn. And I guess it really kind of at a high level has 4 categories to it. So for every deal we do, because there's a buyer of the business or an entrepreneur, we have to vet the entrepreneur, right? Ask if they're a good fit for the business they're buying. Are they someone, we're excited to work with that we believe can kind of execute on their value creation plan? Then we vet the company, right? So we've got a whole host of criteria, how we kind of conduct business diligence on the company. And then there's a more wholesome diligence process around ours, right? That's going to consist of legal diligence, quality earnings, financial diligence. There's often kind of more specific work streams like insurance due diligence, and in certain cases, environmental due diligence, things like that all get conducted around our focus, which is business, but we'll take all that other stuff and apply it to our consideration. So that's the company. And then we look really closely at the terms of the deal. And that's both the terms that we're buying the business on. So what are the terms of the either share purchase or asset purchase? And then what are the terms that we're receiving as an investor in this deal? And those move around a lot. This is not a space where it's highly benchmarked like in venture capital. This is a space where, one term sheet could look wildly different than another. And as an investor who's sees, call it 250 or so of these deals a year, I really don't know how else someone could get a firm pulse on the market. It's really challenging unless you're seeing lots of deals, right? Because there's a lack of benchmarks. So we do some work to put out reports and things like that to give more of a kind of view into the typical terms that you might expect to see and what to kind of look out for. But yeah, that's kind of the third part of the process. The last part is a kind of combination of the industry and, like I mentioned earlier, the local market, which is key, right? These are local businesses, typically speaking. They have local economies of scale. We need to understand if that local market is healthy. Is it growing? What does unemployment look like? Is it aging? All that good stuff. And then the industry, of course, similarly, I talked about some of this just a minute ago, but low cyclicality, growing industry, generally speaking. And yeah, that's sort of the parts that we continue to refine more so, I'd say, than the thesis itself.
So I love the parlay here. I would love to kind of dive into that due diligence process and really understand maybe the go, no go process. I'm imagining you do an initial due diligence period. And then if it meets some high level stuff, then you go into the legal and environmental or whatever I imagine comes much later. Can you kind of go into that process and frame why you've structured it that way?
Yeah, absolutely. And I just posted recently on LinkedIn about this, so it's very fresh. The kind of breakdown I'd give is largely based on the typical process people will experience when they're considering investing as a passive investor in one of these small business acquisitions, right? So whenever you're considering one of these deals, it'll often start out that you'll come into contact with a buyer who needs some equity, and they'll send you a teaser, which is basically a blinded, one pager on the deal. It'll have, no kind of sensitive or identifying information about the company, but it will tell you in most cases what the financials have looked like for the past 3 years. It'll tell you, the business model, the location. It'll typically highlight kind of notable risks, like if there's substantial customer concentration or if there's, certain cyclical exposure, things like that. That'll all be highlighted in the teaser. So what we do when we get a teaser, we have some key items that we look for right away. And because we look at so many deals, we need to be able to screen pretty quickly at the teaser phase so that we don't waste our time or the buyer's time. So we'll immediately ask, is this an essential business? Is it serving attractive end markets? If we can answer those both, we have a checklist, right, that we'll mark that in. If it's incomplete, we leave it incomplete and typically assume that that's a fail unless we can, I'll come back to that. But basically, if everything else passes and it's contingent upon that one thing, then we'll go to the sponsor to ask, if we're asked for the information to confirm or deny that. But we kind of come back to that at a later point. And we continue through these key items. We typically like to see purchase multiples below 5 times trailing 12-month EBITDA, and kind of average purchase multiples that are higher than that, because assuming the business has been growing, but not too so out of whack that, it's clearly a volatile case of earnings that have moved the multiple all over the place, right? So those are kind of some of the key criteria we start with. There's a handful more, but basically we go through until we get a sense for, is this a deal that could potentially pass if we answered more of these items? If so, we'll send over an information request or we'll sign an NDA and move on to the next phase with the buyer. But if there's so many items that have failed that even if we answered more of them, it's at a point where it's, just not going to be a fit, then we won't waste anyone's time from there, right? So that's how we kind of get through these teasers pretty quickly. Assuming we get to the next phase, you'll typically get under NDA, you'll get what's called a CIM, or a confidential information memorandum. Some people call it the investment memo, the investor memo, lots of different names. But it's basically the teaser blown out into 40 pages, right? So like if every section of the teaser had, 10 pages on it in granular detail, that's the investment memo that buyers will typically present. And so we correspondingly have a longer checklist. What I mentioned earlier is about 215 items. We go through the CIM. We mark up our checklist based on this confidential information memorandum. keeping in mind that the confidential information memorandum is meant to present facts, but it's also still to some degree a sales pitch, right? So you've got to kind of focus on the data, focus on the numbers and the key information that are in there that aren't necessarily more narrative driven, and use that to kind of inform your checklist process. And similarly, if we get to a point in our checklist that says, hey, this deal could be a great fit, we have a few more items we need to answer to confirm that, we'll send the information request over, and generally we'll progress into reviewing a full data room at that point, right? You can kind of see the whole process in these first two stages is all structured around efficiency and making sure that we're being thorough, but also getting through deals at a good pace, right? That's kind of what we need to be doing to process a good volume. From there, we'll put together our own model. We have a model that's kind of structured to look at all these different types of investor terms, the different acquisition structures, and we'll use that to evaluate our target return, and really ask the question of that model, what would need to be true for us to hit an attractive return profile, right? Because that's, in my opinion, that's the best value of a model, is you can set it to whatever target return you want. Anyone can build a model that says 20, 30%, whatever you want it to say from a return standpoint. But what you need to ask yourself is, well, what actually needs to happen to hit that? So if we build our model and it turns out that the business would need to grow at, 25% per year for the next 7 years to hit that target return, that's a pretty tall bar, right? That's a pretty tall order. Versus if we see, the deal can stomach a 50% decline in EBITDA because the debt structure is healthy, we'll still receive a return that's above the S&P 500. But if it grows 4% per year, which is pretty manageable, that's usually in line with the industry. Frankly, that's been in line with inflation for the past couple of years. That's been below inflation, right? So that's a much more credible assumption. If we have these credible assumptions that allow us to hit our target return, that's when we start to move into kind of the full data room. Our checklist is passed, so we're gonna get really granular, going through contracts, going through all I would say the third layer of information we request. And we're going to build out a more granular model with a revenue build that's not just based on growth rates and target margins and things like that. It's based on the actual key value drivers of the business. So for example, if I'm looking at a services business, I'm going to be looking at the highest level revenue driver, which is typically something like hours booked or hours billed, or maybe base it on the number of contracts they have, average contract value, average job size, and build down to revenue using those value drivers to really understand what would need to be true, right? Then we can understand, well, how many jobs did they do this year? How much capacity do they have based on the org structure, and the asset base if they need vehicles or something similar? And then how many jobs would they need to do to hit our target EBITDA earnings figures and our target return? And we can really see, how will they be able to scale that much? Is the cost realistic that we've thought about? Does that imply a realistic margin profile? What would hires need to be like? Capital expenditures, new goods. We can really see all that stuff and understand that question of what would need to be true. Assuming all that stuff checks out, and that lastly that the terms are good that we're receiving. That's kind of right. The triangulate all that back around. We'll move forward with the deal.
So if I'm going to recap, basically you have how do I spend as minimal time on the front end and have a couple check boxes, things that they need to go through, all the way through like super heavy going and building a model, reviewing documents, and you basically have this checklist that you are picking off. And that's as you go through the deck. If it meets enough criteria, then you might talk to the operator or get the deep dive, and then so on and so forth. Do I have that right?
That's right. Yeah, it's all about efficiency, not wasting other people's time, not wasting our own time. And when we find something that's a really good fit, spending a ton of time on.
Yeah. So I'm going to make a plug right here. This is exactly what we teach inside the Cash Flow Academy. So is helping investors figure out a system for investing in deals. And I think Sean was just very eloquently described how that process should look. And that is exactly what we teach you. So if that's interesting to you, I encourage you to go to growyourcashflow. Great plug there. So Sean, can you talk me through give us an idea of how many deals are you looking at? I think you made an amazing point where you said the only way you can really know what's a good deal is by really seeing a lot of deals. I think that is, I echo that point. I say that all the time. I think that's worth highlighting. Talk to us about, is this every Monday you open your inbox and you look at 5 deals? Is it you look at a deal a day? Do I think I read somewhere that you have invested in 2% of all the deals that you've come across. Talk to us about that.
Yeah, as of the last kind of investor update I sent out, it was just under 2%. It was about 1.8% of the deals we see that we end up closing. It's less than that, because a lot of the deals, are just not a fit at the really high level. Maybe they're, not in the US or Canada. So that just disqualifies them off the bat and things like that. So yeah, call it 2% of the qualified deals that we see that we invest in. Deal flow is a bit lumpy, I would say. It feels like it comes in spurts and then it can be a bit quieter. But I guess just for some high level metrics, in Q2 of this year, we saw roughly 70 deals in 1 month. It was like 65 deals or something like that in 1 quarter. In Q4 of the prior year, kind of, around the holidays, Thanksgiving, you got lots of reasons to not be doing as many deals. I think we saw maybe 25 or so, right? So it's very lumpy, kind of on a quarterly schedule to some degree. But we saw over the past kind of 12 months, we've seen, I believe it was almost 300 deals. It was between 250 and 300. I would say most of that nowadays, about 75% of that nowadays, is directly inbound to us. Probably about 15% of that or so is referral, and the rest is us. We look on, there's websites. One's called searchfunder.com. One's called Mainshares. There's other websites where we look on these websites and we can find businesses that are like listed, raising capital. So that's probably the last 10%. It's probably a little less than 10% at this point. So yeah, I would say a lot of that comes inbound. And that's sort of the nature of this asset class. Listing platforms, things of that nature, it's very nascent. There's not a lot of deal flow that's raising equity, generally speaking, like relative to real estate, for example. It's a fraction of the amount of, equity raises that you see in real estate. Although on kind of a probably broader scale, there's a lot of these deals that don't even come to the market for investors like us. They get fully financed by the buyer themselves or by friends and family, things like that, right? So there is a tremendous amount of deal flow out there for buying and selling small businesses. But the deals that actually come to equity investors, they are very network driven. They're very kind of direct. If you have a presence on digital platforms or within the communities, if you don't have that, you're going to be pretty unlikely to see these types of deals, at least at scale. The deals you'll see will probably be a friend or a family member who's buying something.
How are you? Have you been working on trying to increase your deal flow? Like, are there other areas you haven't explored? I imagine there are some sources where you're like, this isn't worth putting more time into. Talk to us about how you're adding or deals to your deal flow.
Yeah, I would say definitely being present in the community and present on digital platforms is a key way to drive deal flow. I would also say, in some cases when we're aware of a business that's selling that seems interesting to us or fits our thesis, we can connect that with searchers that are in our network, with buyers that are in our network, right? So that's one way to kind of control your own destiny a little bit more, and that's interesting. And then generally, referrals from other investors are typically pretty high quality deals. So we certainly look to continue referring deals and getting referrals. And, we love partnering with investors that we know, and for a variety of reasons. So I think that's also a key approach to seeing more deal flow.
And I imagine it's all across the stack that people are investing in this. There's anything from small LPs like high net worth. There's family offices. There's probably institutions that are doing this. Can you talk about who plays in what space? This is maybe small market. Maybe there's the institutions are playing in middle market. Talk about that.
Yeah, it's a great question. So starting with kind of the smallest deals, the ones that are a self-funded searcher, a self-funded buyer who is using an SBA loan and buying a business that's probably around $500,000 to $1 million in earnings, you're not going to see really any institutions in that space. The closest thing to an institution are, funds like ours or some of the other kind of similar funds in the space. When you start to go up to maybe 2 million or more like 3 million in earnings or so, and you start to need more equity in these deals, that's a key piece of it, is just how much equity is needed. You'll start to see family offices paying attention. Usually those deals are in that class that I called independent sponsors. So those are folks that are buying the business. They're typically, maybe they'll be the CEO for a year or two, but they're typically looking to put an operator in charge of the business, and they'll step back into more like a chairperson type role. So you see family offices participating, I would say, in smaller deals than they used to in that space, which means they write slightly smaller checks, which is, generally considered kind of inefficient, back to kind of the efficiency concept. If they're spending a bunch of time on a deal but writing a smaller check, it's not as efficient as if they're spending a bunch of time, same amount of time, but writing a larger check and deploying more capital, right? So while they're stepping down, I think there's still a preference from family offices in deals that have 5 million or more in earnings, where they can usually deploy, call it a $5 million check or more, right? I haven't even started talking about institutions. We are aware of some institutions that, and when I say institution, I mean more like a fund of funds or, a very large allocator. There's fund of funds that have raised $1 billion or so in assets, and they'll invest in larger independent sponsor deals. I was just speaking with a gentleman yesterday. Their minimum check size is typically $15 million. So if you don't have $15 million in equity that you need, they won't start looking, even if it's a phenomenal deal. It's just not worth their time. They can't staff up they haven't built a value chain around that. They can't staff up a deal team to focus on a deal that only needs $1.5 million of equity. So those deals typically tend to be more like $10 million in earnings or so, right? In that kind of 5 to 10 plus range. What that means is that for folks that do want to deploy capital in these smaller deals, you have this sort of artificial, barrier that keeps the deals looking good, good multiples. It protects from too much capital overweighting the asset class. And it allows kind of smaller investors to really get a seat at the table and generate some nice returns. So I'd say that's a pretty unique dynamic here. While it's, less attractive if you want to deploy high magnitudes of capital, it can be a really attractive space if you want to dig in and kind of remain competitive while deploying high 5-figure, low 6-figure checks.
Yeah, everyone, there's different levels that people play at. And if you're a retail LP, it's hard to participate in those larger institutional deals, very different deals. So I'd love to kind of use that as a transition. So, I think learned a lot about your due diligence process, how you approach deals. I think that was awesome for everyone to listen to, myself included. Can you now kind of shift the perspective of, if we are an LP and this is interesting to us, we're interested in either investing in a fund like yours that does this, or we're interested in investing in, if we see these types of deals come across our desk, what are some of the big maybe learnings or misconceptions that people have as they get into this space? Maybe some of the misconceptions you had getting into the space.
Yeah, absolutely. I'd say there's a couple things that I had as a misconception, but one of the biggest ones, for folks that are thinking about coming into this space, there's plenty of deals out there that you'll be able to find if you start on like Search Funder or with us at SMB Investor Network or with Main Shares, or for example, all these kind of different, there's not a ton of them, but there's enough if you start Googling these platforms that have deals. A lot of them, the entry ticket will be $100,000 or something like that, right? So that's a little tricky for many folks. What we've started doing, because we have the fund and we're able to stand up SPVs and run co-investment processes, we've dropped the ticket sizes down to $10K for folks. One of the value props there is that folks that are new to the space can kind of dip their toe in the water and learn about these misconceptions that you might have about the space. We also look to eliminate a lot of the misconceptions, which I'll talk about in a sec, because we look at all these deals and underwrite them for the fund. right? So one of the biggest misconceptions I think I've seen when folks start investing, they go on the platforms, they find a deal, they want to invest, and they don't look closely enough, or maybe they just haven't seen enough deals, to my earlier point, to understand the investor terms. That's a big one that can cause a lot of risk for kind of going direct on a lot of these deals. And I think that we've really aimed to mitigate through our syndications and through our platform. So, a couple examples. You'll see, I think a lot of folks are probably familiar with the concept of preferred equity, which generally means that you get your equity contribution, your invested capital back first, one of the terms. You get a liquidation preference, you get your capital first. You get some sort of preferred return, which is usually 8 to 10% compounding, maybe more than that, somewhere in that range. And then the rest of the proceeds are split on some sort of profit share or share of net gains with the actual buyer. That's a common structure, I think, in lots of these sponsor-backed investing strategies, and also in this small business acquisition strategy. The challenge is those structures, those splits, are all over the place. In deals that have an SPA loan in place, oftentimes the buyer of the business is personally guaranteeing the loan. They've spent a bunch of time finding the business, they've paid for diligence, they've taken a lot of risk. So accordingly, they should get probably an outsized share of that business. But in certain cases, people can get carried away, and you can see deals where there's the business is saddled with debt after it's acquired. You can use 90% debt to acquire these businesses. And if you're not buying them for cheap, if you're buying them for market and you're putting 90% debt on them, it's going to be a tall order to pay down a lot of that debt, right? So, and that's all sitting in front of equity. So that's a substantial amount of risk. But what compounds that is, in many cases, you'll see, investors walk away only owning 10 to 20% of the business, which is not commensurate with what they hypothetically should be owning in a typical leveraged buyout. So you need to really scrutinize these terms and understand, what am I owning? What does the capital structure for this business look like? And what is this business being bought for? Is that in line with market, or is it, a value purchase? And can it kind of comfortably support this debt and bake in our kind of return just by paying it down? You got to look at all those things. You got to understand how the term sheets and ultimately the operating agreements or shareholder documents are structured. Otherwise, you could be taking a lot of undue risk that you're not getting compensated for. So that was something that we kind of found we didn't realize coming into the space, right? In typical leverage buyouts, private equity type deals, there's a management fee, a carry. There's, the equity investors own 100% of the business, diluted by whatever management equity and whatever carried interest there is. That's not generally how a lot of these deals are structured. So yeah, that was a bit of a misconception. I would say, we've moved towards doing more of these independent sponsor type structures, albeit kind of the smaller ones, because they have a fee and governance terms that are more in line with what I just outlined, right? Investors will own more of the business, returns will be slightly more correlated, and your capital will be a bit more protected. We've seen other terms that basically allow the buyer to distribute themselves a bunch of proceeds before they distribute proceeds to investors. We've seen all sorts of stuff. So I could go on and on about that, but yeah, the concept of just understanding the terms is a really big one.
What are maybe some advantages of investing, or what's a compelling reason maybe an LP should look at investing in small businesses versus maybe a real estate syndication or oil and gas, or pick your LP deal flavor of the week?
Yeah, well, I would say the types of businesses we look at least, there's a pretty attractive risk adjusted return profile on a lot of them. Back to my comment on what would need to be true to realize call it 30% IRR. In many cases, there's not a lot that needs to be done. It can be, 4 to 5% growth of the business and payment of the debt, and you're there, right? That's, generally speaking, to get to a 35% IRR, that's a pretty attractive kind of profile, I would say. So that's one piece of it, the risk adjusted returns. I would say the other piece is, because these are cash flowing businesses, because they have generally, at least again, the ones we're looking at, a pretty strong history, they're durable. They have good staying power, right? So they've been around for a long time. They've endured various economic cycles. If you don't put too much debt on them, you use enough to amplify returns, but not too much that it's now struggling with its credit metrics and things like that. You can be reasonably confident that they're going to continue to be around, continue to kick off cash flow, and again, bake in that return for investors. I would say the last thing, because there's a lot more levers, then it's a little more complex to operate a business than it is in many cases with some fixed assets or other types of investment strategies. There's a lot of different levers in a business, which creates more risk, but it also creates the potential for more upside, right? So one thing we love about these deals is we see them as asymmetric bets in many cases. You've got that kind of protection on the downside. They've been around a while. You can bake in a generally decent return just by paying down the debt in many cases. But for example, if we execute on a great roll-up strategy where we buy 4 more companies that look similar and amalgamate them all into one, and you sell it to a lower middle market PE firm that's paying 10 times for the businesses that have now $6-7 million in EBITDA, because now you're in that institutional investor class. All of a sudden you've made yourself a 70% IRR or something like that, 70% return. So if you have that potential to X your money, but you're also generally fortified from kind of the almost like venture angel investing style approach, that to us is really attractive. It really is almost a hybrid between that venture capital profile and the kind of private equity leverage buyout profile.
I love it. I got schooled today. Sean, where can people learn more about Search Fund Ventures and your small business investor network?
Yeah. So folks can reach out to me, Sean, SEAN, at searchfundventures.co, not .com. And then people can sign up for smbinvestornetwork.com. And once you sign up, you can join our distribution list for co-investments. So would encourage people to do that. Would love to hop on a call with anyone that's interested in this space.
Love that. All right. Thank you, Sean. And one thing I'd mention here as a plug, if you are struggling to get consistent deal flow or you're not sure how to vet operators, I think Sean gave a really great segment here. But if you're trying to figure out how to vet operators, that's exactly why I created the Passive Investing Starter Kit. It'll help you get high quality C deals landing in your inbox and also give you the tools to filter out the noise and invest with confidence. And you can grab that at passiveinvestingstarterkit.com. This year also marks the 10th best ever conference in February of 2026, and it is going to be fire. So if you're an LP, a GP, or just serious about growing your investment portfolio, and you will not want to miss this. We'll be in Salt Lake City from February 18th to the 20th, 2026 next year. And the lineup will be packed with deal makers, fund managers, and serious passive investors. So be sure to grab your ticket at besteverconference.com, and I will see you there. And again, here on the Passive Income Playbook, part of the Best Ever CRE show, we drop new episodes every Thursday. So be sure to tune in each week for more conversations like this one with Sean. And if you enjoyed today's episode, please subscribe, leave us a review, reach out to us on LinkedIn. It really helps for us to reach more investors like you and just get to know the community of who's listening in. So thank you for tuning in, and I will see you next week for another episode of the Passive Income Playbook.